If you are wondering how mortgage rates affect you and understanding them on a better level, then this is a great video for you. I'm Will, and I create videos about living here in Portland, Oregon, along with educational content around the real estate process. I'd love to have a chance to win your real estate business, so give us a call, text, or email. Down in the description will be all of the contact information. So with that, let's dive right into it. So you may have heard of the mortgage rate or interest rate or mortgage interest rate, but ultimately the definition of what this is the part of what it costs to borrow money from a lender. Instead of paying your mortgage lender a lump sum, the interest is paid as part of your monthly payment for your home loan. So to keep mortgage rates simple for you, just think of it as the way for the bank to make a return on the money that they are lending to you. Now, when it comes to a higher interest rate, you are going to be paying a higher mortgage payment. And when you have a lower interest rate, you'll be paying less of a mortgage payment because there is less interest or less needed from the bank in order for them to be profitable or for it to make sense for them financially. Now, when we're looking at the broader economic conditions, when it comes to interest rates, you will typically see that when we are in recessions, those interest rates will come down. And then when we are in better economic times and they need to cool down inflation, they usually will start having higher interest rates. This is just a way to moderate how much consumption is happening and making sure that there's no bad economic downsides when it comes to using the interest rates. Now, you may be thinking this is still a little bit nebulous or abstract. And to give you a little bit more of a concrete number, if you're looking at the interest rates increasing by about 1%, then you're going to see your buying power decrease by about 10%. So that means if you're looking at $1 million home and we see interest rates increase by 1%, now you're only able to afford about $900,000. So keeping that in mind, that's a good rule of thumb, and you can see why when interest rates go up very sharply, it can cause a huge affordability issue for a lot of buyers. Now, some other factors you should be considering as well is understanding the fact that there's different loan types and they might have different interest rates. Typically, you'll see VA and FHA loans have a lower interest rate, but part of the reason for that is because they sometimes will have mortgage insurance and typically will have higher fees up front. Now, when you look at conventional loans, this will be another factor where they may be a little bit higher than the FHA, but they are usually the baseline standard. Now, if you're looking at jumbo loans or investor loans, you'll usually see that these are about a percentage to a percentage and a half above the baseline interest rate for the conventional loans. This is a good thing to just note when you are looking at buying a property and looking at the different types of loan types you may be using in order to purchase said property. Now, switching to the mortgage rates and giving you a little bit more of a definition of what that might look like, you can see that we're going to be using a $500,000 purchase price with about 5% down, along with the total loan amount being around $475,000. Now, if we're looking at this 5%, you can see that the monthly mortgage payment is fairly low, around the $2,500. Now, even if we go up a half a point, that's about a $150 difference. And if we go up a full point, that's an additional $300 per month. And one thing I do want to note is that when you are looking at the monthly mortgage payment, this is also going to include taxes and insurance. So when you're looking at just the mortgage payment or just the mortgage itself, you may see that this is a little bit of a lower number. And it's a good idea to look at the taxes and insurance on top of this, and also maintenance if you are looking into having that factored in as well. So when we look at this 5% and then we're going up to 6%, it's a pretty large jump. And you can see that the total interest also starts increasing. This is the amount of interest you'll be paying over the lifetime of the loan. Now, there are ways for you to make an extra payment a month or make an extra payment a year, and this can significantly drop the amount of total interest you are paying. So these are some fun hacks that you can do. So especially if you're switching from a monthly to maybe every 2 weeks, you can have a payment done. So that way it can speed up that process and you pay less interest. However, this is something where you're probably gonna have to talk to yourself and look at your personal finances and see whether or not it's a better idea to maybe save up that cash for maybe another investment, or maybe pay it all off at another time where you're able to get a little bit more money. It's, again, more of a personal finance question to take a look at. Now, if we're going from 5% all the way up to 8%, you can see there is a massive difference. There's almost $1,000 difference between these two interest rates. And you can see how when we get shocked with the system going from 3% rates all the way up to 6 and 7% rates, those monthly mortgage payments become much more expensive. So this is why it's really pushed a lot of buyers out of the running when it comes to being able to afford these monthly payments. And we'll have to see in general, you'll have to see the affordability have to come back up in order for the people to be buying more. Now, a question that commonly comes up is, what if I buy at this high interest rate and I want to then refinance at another time? And for people who don't know what refinancing means, it essentially means that you are giving away your old mortgage for a new mortgage, and the major difference typically is going to be the interest rate or maybe the terms with that. So if, let's say, for example, you have a 30-year loan when you first buy the home and then you pay it off for about 5 years. Just note that usually when you refinance at that 5-year mark, you then reset that clock to be another 30 years. So keeping that in mind, the way you would want to go about this is making sure that you're talking to a lender and seeing whether or not it is cost effective for you. Because one of the things you need to note when you are refinancing is that you will have to pay closing costs. Now, when it comes to closing costs, you can actually wrap that into the loan. It might make sense for you, but it's always a good idea to talk with your lender and see when the payback period is. Because let's say that you're going to be moving in the next year, it may not be worth it for you to refinance and get that lower rate. Now, usually when you're looking at decreasing your rate, you're wanting to look at least having 1% of a drop, because if it's not more than that, usually the payback period is not very helpful for you, but is always a good idea to double check with a lender. Now, if you need any connections to that, feel free to reach out. Make sure to have my contact information down below, and I'd be more than happy to connect you with a lender wherever you are in the States. Now, before, we've been really talking about having a fixed rate. And one other loan product that might be out there is an adjustable rate mortgage, or an ARM. Now, this might be a time when you see those interest rates start to increase. The ARM essentially is an interest rate that can increase over time. So let's say that the first 5 years are going to be a specific interest rate, and then year after that, it will change depending on what the circumstances are. So if the interest rates in general are higher, then typically they will increase those rates. So sometimes it's a good idea to take a look at the type of financing you have. And let's say that you're getting near the end of the arm where it's going to start increasing in rates. It might be a better idea for you to just switch to a fixed rate, especially depending on if you have gotten that 20%, and switching to a conventional loan might be more advantageous. Now, if you are shopping around to get the best rate possible, then it's a good idea to keep this in mind and go about it in a particular way. Now, let's say that you get pre-approved by 3 lenders. What you will want to do is then ask them for a good faith estimate. This will allow you to compare apples to apples when it comes to the closing costs, the best rate that they can get, and will allow you to see all the costs in general when it comes to the lending part of it. Now, when you're looking at getting this good faith estimate, it is always a good idea to get it on the same day. The reason being is that interest rates can wild greatly from week to week, and even day to day. So getting them on the same day will allow you to have a better idea of comparing the apples to apples instead of having an apple and orange. On top of that, what I do recommend is making sure that they are not adding points or additional costs for your closing costs to buy down the rate. The reason for this is that you want to see how much the rate or the best rate that they can provide. An additional tip I would also give you on this is, if let's say that you find a fantastic lender and they really jive with your personality and they are good and reliable, it's always a good idea to see whether or not they can match the rate or get closer to the rate of another company that maybe you don't quite like as much. Remember, it's very important during a transaction to have a lender that you can trust and also get through it, because the worst thing that can happen is, if let's say that you get through the inspection process, you've paid for everything, and you get to the lending side and they can't finish. That is going to be a huge problem, and is a good thing to note when you are looking at lenders, is making sure that they are local, or they are also very trustworthy, and they have a record of making sure that they're performing well. Now, taking a step back, it's always a good idea to look at the long time considerations when it comes to interest rates. We may see historic times when the interest rates will be very, very low, like in the 2s and 3s. And there will also be times when we see really highs in the 13 to 18%, like back in the 80s. Just know that this is going to greatly change over time. And usually when you're looking at interest rates in particular ranges, usually in the 5 to 6%, that means that they're most likely going to have a more stabilizing effect on the economy, or especially housing. If we start seeing anything lower than that, it's a stimulant to the economy, and especially the housing economy. And if we see it above that 6%, that typically means it's going to slow it down. Interest rates do play a major factor in the affordability of the home, and it's a good idea to note that we don't know what's going to happen. We may see interest rates go up and we may see them drop down, but that's the nice thing about when you do jump into a home, is that you are able to ride the wave either way. So let's say that you get into a home and you have a higher interest rate, maybe around 6 or 7%. And then we see that the interest rates continue to go up. Let's say that they go up to maybe 8 to 10%. At that point, you have locked in a specific rate. And if it's the fixed rate, then you're going to have that for the next 30 years. Now, a lot can change in 30 years. A lot can change in just about 1 or 2 years for you personally, most likely. So with that, if we do see rates dip down, then you can refinance. And this would be a great way for you to lower that monthly mortgage payment. Or let's say it gets to the point where maybe you can rent out your home and then make a profit off of that later on once you have a lower rate. And then you can use the equity from the home. Again, these are tools for you to really start building your wealth. And you should look at it as the long term when you're looking at getting a mortgage, that 5-10 year time frame. Now, one thing to note is that you can also sell your home. If you put enough down and it makes enough sense when you do need to make that move, you don't have to be stuck with a 30-year mortgage for the rest of your life. It is something that is very common to sell your home and then you get rid of that mortgage, but it's always a good idea to plan longer. That means looking at that 5 to 10 year perspective. Now, if you feel like I needed to add anything else, I would love to see your comments down below. And if you found this content helpful whatsoever, it would be wonderful if you could hit that like and subscribe button. If you ever need a realtor in the Portland metro area, I'd be more than happy to help. Again, my contact information is down below. Thank you so much for watching.